Hey, in this video, I'm going to explain the DSCR loan qualification requirements and how to scale your rental portfolio with DSCR loans. My name is Johnny Crossway, and our company, HML Investments, is a direct lender on DSCR loans nationwide. Later in the video, I'm going to show you how we funded one of our clients' DSCR loans to acquire a Triplex, which is 20% down, and the property generates $1,000 in cash flow after expenses each month. So first, what's a DSCR loan? DSCR stands for Debt Service Coverage Ratio, which is just a fancy way of saying that the loan is based on your property's ability to generate cash flow. DSCR loans are not like traditional bank loans that focus on your personal income and your debt to income ratio. None of that matters here. All that matters is that the property produces enough income to cover the expenses. The way DSCR lenders calculate if your property can qualify based on the income and the expenses is what's called the DSCR ratio. And that is calculated by taking the net operating income of the property divided by the total expenses of the property, which is known as PITIA. PITIA stands for principal, interest, taxes, insurance, and association dues, which adds up to your total expenses for your rental property. For example, if the rental income you generate for your single family home is $2,200 a month, and then your total expenses from the mortgage, the interest, principal, taxes, insurance, and association dues add up to $2,000, that means your DSCR ratio is 1.1, which would get you approved with most DSCR lenders. So you're probably wondering, do investors love DSCR loans? And the answer is yes. First reason why investors love DSCR loans is because it's much easier to qualify for and scale your rental portfolio. If you try to scale your rental portfolio going to traditional banks, you're gonna have a hard time because each time you get a bank loan, they're looking at your personal income and your debt to income ratio. So each loan you get from them affects your DTI ratio, which is going to limit you from getting more properties and getting approved for more loans. DSCR lenders do not care about your personal income or DTI ratio. So there's no limit to how many loans you can get approved for, and therefore no limit to how many properties you can buy. The second reason that investors love DSCR loans is higher leverage. We can fund up to 80% of the purchase price, which means as little as 20% down payment from your pocket. Less money down on one property means you can buy more property and have more money on hand in case of a rainy day. And if you want to recapture some of your equity from a recently renovated property or a recently built new construction property, you can get up to 75% of the appraised value of your property as cash out back in your pocket, which you can use to buy more properties or for whatever you like. And the third reason that investors love DSCR loans is the streamlined application process. We don't care about personal income or anything like that. All that matters is the appraisal and that the rental income covers the expenses of the property. Just show a couple bank statements for the down payment, your entity docs, title insurance, and property insurance, and you're good to go. And now I'm going to show you guys a case study of a recently funded triplex that we just helped our borrower acquire in Lawrence, Massachusetts. They bought the property for $616,000, and we gave them a loan of 80% of the purchase price, which was $493,000. So they only had to put 20% down on the purchase. The rental income of the triplex was $4,800 a month, and the total PITIA, or the expenses of the property, was only $3,700 a month. So it definitely met the DSCR ratio requirement of 1.1 to get approved, and they're generating $1,000 a month in free cash flow. So you're probably wondering, Johnny, what's the catch? How do I qualify for a DSCR loan? Well, here's how you do it. The first requirement is having a credit score of 680. Lenders like us want to see that you're a responsible borrower with a solid credit history. The second thing to qualify is the DSCR ratio, which means that we need the rental income to be at least 1.1 times greater than the expenses of the property. The third requirement that you need to learn about is the LTV, or the loan to value ratio. That's the percentage of the loan amount divided by the purchase price of the property. So based on your credit score and the DSCR ratio, you can get up to 80% of the purchase price funded, or 75% of the property as cash out if you're doing a refinance. Some other important items to consider when qualifying for your DSCR loan is liquidity. Most lenders like us are going to want to see that you have at least 6 months of principal, interest, taxes, insurance, and association dues as reserves in your bank account or 401k or stocks or liquid. And as far as leases go, if it's a purchase, it's okay if the property is vacant at the time of closing. If it's a refinance, there must be a tenant in place. So we're going to need to see the lease agreement and proof of a security deposit if the lease is within the last 30 days. I hope this video brought value to you. If you need help getting qualified for a DSCR loan and want a quote so you can scale up your rental portfolio, click the link in bio to get pre-approved today. Thanks for watching this video all the way to the end. If you got value out of this, definitely like, share, and subscribe. Check out our show, The Hard Money Lions, on YouTube here. And don't forget to Roz it up.